As interest rates keep rising and inflation goes out of the roof, a high dividend ETF that can generate extra income is always nice to have. Today, we're going to compare 7 high-yield ETFs that give you Australian stock market exposure and 3 high-yield global ETFs that consist of companies that generate attractive and sustainable income. At the end of this video, I'll compare their performance to see which ETF provided the highest income return, not dividend yield, while not compromising the price return. Now let's start with the Australian domestic high dividend ETFs. Like dividend stocks, high dividend ETFs can easily fall into the dividend traps as well, which I delve into details in one of my income investing series videos here. Although they are called high yield ETFs, they're not created the same. For example, VHY focuses on forecast dividend yield. Therefore, it is more immune to this trap than ETFs like IHD and ZYI, which use past dividend history to filter out the dividend stocks. Meanwhile, RDV adopts a hybrid approach using both historical and forecast metrics. When constructing a fund, a higher dividend paying stock is more likely to be a value stock, and you want it to be a mature value company that they don't need the dividend to grow their business. And value stocks are more likely to be resilient in the market downturn, which means that the stock price wouldn't suffer much. The 7 ETFs are following different indices to screen out the high dividend stock, and with the oldest fund established 13 years ago and the youngest fund being VanEck Morningstar Australian Mode Income ETF, only 3 years old. In terms of the fund size, VHY Vanguard Australian Shares High Yield ETF is the most popular fund with 4 billion asset under management. In terms of holdings, RARI Australian Responsible Investment ETF holds the most stocks with 99 holdings, and DVDY, the youngest fund, holds only 25 stocks. If we look into their sector allocation, the top 3 dominating sectors for high dividend stocks in Australia are financials, materials, and energy. And we can see the 5 ETFs are pretty much following this pattern, with materials and financial stocks taking the top weight. However, we see real estate and healthcare companies in ETF RARI, probably due to their index methodology to select more companies with higher ESG scores. And due to the special index DVDY is tracking, the top 3 sectors are totally different from the rest of the ETFs. When it comes to distribution frequency, 6 of them distribute dividends quarterly. Only RARI does it every 6 months. Let's look at the management fees of the 7 funds. IHD and VHY are on the cheaper range. ZYI, RDV, ZYAU, and DVDY are slightly more expensive. And RARI, the ESG High Dividend Index ETF, has the highest fees with 0.45%. And one thing I have to repeat again, ETF investors do not pay these management fees directly to the fund manager, and the management fees and costs are accrued daily and deducted on a monthly basis from the fund assets and are reflected in the daily net asset value price of the ETF, assuming an investor purchase shares at net asset value. Although each fund has published its annualized total return since inception, however, I noticed some funds only published the 12 months trailing yield. Some published the fund distribution return, which is the income return. Income return and dividend yield are 2 different things. To work out the income return, you use all the dividends received in a period of time divided by the total invested capital. And to work out the dividend yield, you use the annual dividends per ETF share divided by the price of the ETF. A high dividend ETF would have both a high income return and a high dividend yield. However, the income return would normally give you a true picture of how well your invested capital generates income for you. The reason is the dividend yield can be higher when the ETF shares decreases. So what I did was to invest $1,000 to each fund on their inception dates to see their real annual income return, price return, as well as the total return so that we can compare apple to apple. So here are the results. VHY is the winner here. Not only it provides the highest dividend return, its price return is not bad, and making its total return of 12.24% per year. On the other side of the spectrum, IHD, ZYAU, and RARI's price returns are all negative and dragging their total returns to around 4 to 5%. How about we compare them with the broad market index ETF? VAS, that mimics the Australian large cap stock market, to see if VHY is worth to invest for the yield? I got that result for you. There's no doubt VAS provides better capital growth, but I have to say its dividend income return is not bad at all. Overall, the total return of VAS only outperformed VHY by 1.45%. If you invested in VHY, you would get more dividends to be collected along the way, but every $10,000, you would have $145 opportunity cost if the money was otherwise invested in VAS. Lastly, let's look at the franking level of each fund. When we buy a stock, PHP for example, BHP generates all of its profits in Australia and pays 30% Australian company tax on net income. When some of this net income was paid as dividends to shareholders, you'll be giving franking credits attached to the dividends, and this non-cash payment simply reflects the fact that a 30% tax has already been paid by this dividend. If there were not the franking credits, this income would be taxed twice. Once when the company makes a profit, and then again in your hands when it's received as dividends. If your personal tax rate is less than 30%, you can actually receive any excess franking credit as a refund, and this is the case for purchasing dividend stocks. In fact, ETFs or managed funds pass through the franking credits to the end investors. We can see the franking levels of ZYI, RDV, VHY are all about 85%, so is VAS franking level. Now let's move on to the 3 high-yield ETFs that capture some global companies. If you want to use ETFs to build your dividend stocks portfolio, one from the above 3 Australian high-yield ETFs that we just covered, plus one of the 3 global high-yield ETFs that we're going to talk about, this will give you an instant market diversification, as the 3 ETFs are pretty much excluding Australian market, except WDIV currently has 2 Australian companies, JB Hi-Fi and APA Group, 1 consumer retail and 1 energy infrastructure company that only take about 2.3% in the total value of the ETF. And we'll look at their country breakdown in detail later. WDIV Spider S&P Global Dividend Fund is the oldest fund here, which was established 10 years ago. ZYUS Global X S&P 500 High Yield Low Volatility ETF 8 years ago. INCM, the youngest fund, was established in 2018. And WDIV is the most popular fund here with 358 million under management. INCM has 24 million. In terms of holdings, WDIV and INCM holds around 100 companies, while ZYUS holds 50 global companies. In Australia, the high dividend sectors are normally the banks, mining companies, and energy stocks, but moving to global companies, we normally see the real estate REITs, utilities, and consumer staples, those established value stocks. In terms of geographic coverage, WDIV and INCM both have broad market coverage, but it's obvious that they have their different focuses. And WDIV tries to cover not only North America, Europe, it also has many Asian companies in China, Singapore, Taiwan, and South Korea. And it does have 2 Australian companies taking about 2.3% of the total assets. INCM has more than 60% in US companies, and it doesn't have many Asian companies except 5% in South Korea. US companies dominate ZYUS portfolio with 1.8% in Ireland and 1.7% in British companies, as it screens stocks from the S&P 500 index that have low betas to aim for low volatility. When it comes to distribution frequency, ZYUS and INCM pay out dividends quarterly, while WDIV does it semi-annually. The management fees range from 0.35% to 0.5%, with WDIV being the most expensive fund of the 3. Now, the most exciting part. Like what I did to Australian high-yield ETFs, I invested $1,000 to each fund on each of their inception dates, and here are their income returns, price returns, and total returns. Despite being the most expensive ETF, WDIV provides the highest total return, with income return slightly lower than the one ZYUS provides. However, ZYUS price return is negative, which could be an indicator that there are some stocks have fallen into the dividend trap. And there is zero capital growth in INCM. The income return is about 3.77%. Again, let's compare with the popular global broad market ETF VGS. The number clearly shows that VGS has much more capital growth capacity and therefore its total return. If you invested in WDIV, you would get more dividends to be collected along the way, but every $10,000, you would have $845 opportunity cost if the money was otherwise invested in VGS. If we factor in compounding effect for 10 years, the total profit you will miss is $6,728. Alright, I hope this kind of product review can provide you some information that you were looking for. And please don't use them as investment advice and do your own research because the performance data are dynamic and past returns are not the guarantee of future performance. And I can do yearly review if you like this kind of content, or if you want me to review or compare any investment products, please comment below. My name's Irene. I'll see you next time. Bye.